Okay, hello everybody, this is Dr. Welker. This is lecture module 5, investment criteria. This particular module comes at a moment where we basically evaluate different techniques that are used, right, to assess the desirability of long-term asset acquisitions. Here we're in the area of capital budgeting, okay? And capital budgeting is the process of making these long-term fixed asset investment decisions. What you note, for instance, maybe think of a capital-intensive firm. These would be firms with high percentages of fixed assets within the mix of their total assets. This becomes a very critical decision for this kind of firm, and mistakes are very painful to rectify. So a well-educated business student has to understand some of the decision-making options that the firm has, tools basically, to help us assess the project choices that we face. You have to understand the strengths and weaknesses of these methods. The techniques that we're going to discuss, sort of each in its own turn, run as follows, right? So you have the net present value. We'll also look at the profitability index. This let's see, this third item is internal rate of return, which you saw looking at the Higgins problem from week 2. I'm going to put a line right here and note another method often used. Here we're talking about the payback method, and there's something related to it, the discounted payback method. Okay, and an accounting rate of return. Right, so these techniques, the techniques that are above the line are all project cash flow based. They discount, right? They will discount the project cash flows. And these methods use market-determined discount rates. So there aren't any what we could call ad hoc elements. So no ad hoc elements, right? So here we're talking about using, let's say, right, market determined, right? Discount rates. Now, these are all going to be referred to as, right, as DCF techniques, we call it, right? So this discounted cash flow techniques are above the line, okay? And below the line, well, let me just mention something, right? The DCF techniques are actually frequently used in corporations now. We know from survey evidence that large firms are much more likely to use these tools compared to smaller firms. We also know that firms where there are CEOs with masters in business administration, you tend to see the DCF methods get used. The last two methods then, right, the below the dotted line, that section is something that's not really considering the time value of money. Right? So these two sections, right, or types, the payback and the accounting rate of return methodology, because they do not use the DCF technique, there are some problems that exist, and they're inadequate as a result of not accounting for the time value of money. There are also some other problems that will come up. We'll discuss them a little bit later. Let's do a brief comment on what I mean by R, by the by the discount rate. Right, the opportunity cost concept is what's going on here. When we're capital budgeting, we're making a decision about taking financial capital to basically fund a project, right? And the idea here, the required rate of return, R, is meant to be thought of as basically looking at a wide variety of possible projects. The owner of the cash could invest this at a certain rate of return established by the market. Right, so cash flows from a project that you would finance, right, should cover the outlays for the project and then generate a return. And this return should leap over a hurdle, we'll call it. And that hurdle is the opportunity costs of the investment. Now what we're going to notice, though, is that not all of the DCF methods are created equally. So there's going to be some confusion and some messiness, we'll call it. After the dust settles, what we're going to notice is that the method that wins, right, is net present value. So we'll look at all of these methods, and what we'll do to sort of take them each in turn and make this point A. We'll discover what's going on with net present value. Now, all of these methods are helping us analyze, right, capital budget projects. Now, which ones would I value more highly, right? So I want more cash rather than less. I also want cash sooner rather than later. And I prefer less riskiness to higher levels of risk. Right? That's the criteria that our investor will have when we take their money and try to find a good project. Right? So the proper tool of analysis needs to account for this. That is, we would want to select a project that meets these criteria. And what we're going to discover, right, that NPV, net present value, actually satisfies the criteria. And it has become the main tool of choice among the well-trained financial managers. So I'm about to study NPV, but we're going to bring up the other methods. And so one might wonder, why would I do that? Why would we look at other methods when they're not really as adequate as net present value? That's a good question, right? Suppose you work for a firm and it's not using net present value, and that might happen. There might be, as a result, a lack of insight into the strengths and the weaknesses of whatever method they happen to be using. And, right, you want to be able to contribute to your firm by presenting to them, right, the virtues of the net present value approach. Why is it better? Why it is much more effective when you're considering capital budgeting, why it is a better evaluation tool, right? So net present value, right? The net present value decision rule, right? The decision rule is that you should take positive and net present value projects, right? So when NPV is greater than 0, we say yes to a project. When it is negative, we reject those projects. We say no to such projects. And we know from our basic sort of concepts here, net present value is the present value of inflows minus the present value of outflows. And what we're doing, right, we're discounting all the cash flows at a proper rate of return. use little r. And we'll figure out a little bit later how we will determine r for the particular project at hand. Now, why this would be a desirable methodology, the net present value, let's look at the basic mechanics. We're going to have a project, let's say, that has a required rate of return of 10%. Just for the heck of it, we'll say 10%. And let's say that we're going to see cash flows in this project. Time period 0, 1, 2, 3, and 4. Let's say we've got a $5,000 outflow, so we're going to call that negative, right? Then we have, let's say, 2,000, let's say 2,500, then 3,000, and then 2,000. Okay, so that's just in thousands. And we know, right, the net present value, again, you could practice this with a spreadsheet, or you could do it on your calculator with the appropriate tools in place. Okay, so time period 0, 5, minus 5,000. Then we go plus, let's see, 2,000, discounted at 1 plus 0.1, right? And that's in period 1, so exponent of 1. And then we have flow of 2,500, discounted at 1.1 squared. Then we had, what, 3,000. Discount that at 1.1, cube that one, right? And 2,000, discounted 1.1 to the fourth power. That gets us a net present value. For this project, it's 2,504. Right, so we have a positive NPV, and you've increased shareholder wealth, right? So we want to say yes to this project. Right? This project is going to be something that is attractive to investors. So we accept the project. Suppose there's in this, let's say there's this firm, we've installed the project. Let's say there are 1,000 shares of common stock outstanding. So 1,000 shares. Right, maybe we're a little small corporation. And the value of our firm now has risen by $2,504, right? So 2,504, the value of the firm, divided by the 1,000 shares, indicates that, right, the share price would rise by 2.504 when the firm announces the project. Right, so NPV is measuring the increase in the wealth of the shareholders in dollar terms. The project here is earning more, right, than the opportunity cost of the funds indicated by the discount rate R. So just notice what NPV is all about, right? So first aspect here is that it focuses on cash flows. Okay. Secondly, we're identifying the timing of cash flows. It's very important. And we are accounting for the risk of cash flows. Now, of note, the riskiness issue is expressed by basically the discount rate R. If you have higher risk, what we would do is adjust the discount rate R upwards. Okay. This measurement in dollar terms is consistent with the target objective, which is to maximize shareholder wealth. Here, the wealth is expressed in dollars. It could be expressed in any other kind of currency, and you could still do this analysis work in those other currencies, right? Next, let's work on the profitability index.